Hi and welcome to AJ Bell Connect. My name is Matt Jonas. I'm the Business Development Manager at AJ Bell Investcentre for the North East. Over the last few years, we've taken the AJ Bell Connect seminar nationwide, but due to the COVID-19 pandemic, we've decided to do this event online for the time being, but we do hope to be back with our face-to-face sessions in December. Please feel free to ask questions throughout the sessions via the chat function. We will endeavour to get back to you quickly. A feedback form will also appear on screen immediately after the session, so please jot down any questions for our speakers using that online form. We'll ensure all speakers receive your questions following the event. Today's session will last 2 hours. We've made some time for you to grab a coffee partway through, and for those of you that watch the session in its entirety, CPD certificates and a copy of the slides will be sent via email in the coming days. Hopefully you're settled in for the afternoon, you're ready to enjoy our thought-provoking sessions, and all that remains for me to do now is announce our first speaker, Ryan Hughes. As Head of Investment Research, Ryan has nearly 20 years experience, having worked for a leading investment management firm before joining AJ Bell.
Hello everyone, my name is Ryan Hughes and I'm Head of Investment Research here at AJ Bell. I'm delighted to be talking to you today, really to give you an update on the university investment world over the last 12 months, pretty much, as well as bringing you up to date with what's going on in investment markets right now, the key topical issues, and then we'll be looking at one of our services and maybe how we can help you with your business, the AJ Bell Fundamentals service here. So just a quick agenda. This will take about half an hour, I would think, to get through that. So as we said, a quick introduction to AJ Bell Investments. There'll be some of you watching, I'm sure, that haven't had too close a look at our investment business. So I'll talk you through that. We'll look at some of the key regulatory drivers in the investment world over the last few months. Important to stay abreast of those. What's going on in markets, particularly thinking about bond markets as well. We'll look at that quite closely. And then how can AJ Bell help you, and we'll summarise at the end. So let's crack straight on. We'll go right into an introduction to AJ Bell Investments. Now, we've been around quite a while now, actually. 5 years as a part of AJ Bell to help support the broader business and bring some investment solutions to market. Now, I'm delighted to say that we've now reached and gone through over 2 billion of assets under management. So we thank you all for your support over the last 5 years on that journey to get us to that fantastic milestone. Now, we've done that through having a wide variety of different strategies that can help you with your business for solutions for your clients. Starting off with passive solutions and then in an MPS and a fund form, active solutions there for MPS. We've got our own range of passive funds, income funds, as well as a responsible growth fund that was launched last year, and a responsible MPS, which we recognise is a rapidly growing part of the market. So we would be delighted to talk to you about any of those solutions to help you with your client needs, as well as a retirement portfolio solution. We're aware that lots of advisors are starting to think about their post-retirement solutions from a portfolio perspective. And so again, we can talk to you about any of those. So we would be delighted to help in any way that we can. So that's a quick intro into AJ Bell Investments. Didn't want to dwell on that for too long. What I did want to do was get stuck into some of the key regulatory issues that have been happening in the investment market over the last 12 months. Now, I think first and foremost is probably we can talk about illiquid assets and particularly commercial property. Been very, very topical for quite some time. If we think back to the illiquid assets point, we can actually go back right to the demise of the Woodford Equity Income Fund, really when illiquid assets became, I think, very topical and people really thinking about, are they appropriate for a daily traded portfolio? What's the right structure for them? How do they get used in portfolios? And so it started with the illiquid assets. It's moved on to property and commercial property. Now, commercial property has had lots and lots of issues over the last decade, really. If we go back to 2007, funds suspended before the financial crisis. If we then look at 2016, physical property funds suspended again due to the Brexit referendum. And then when we look at the pandemic at the start of 2020, well, we saw the whole sector suspend there, and people couldn't get their money back when they wanted it. So, not surprisingly, the FCA has been taking a very close look at this and thinking about what is the right structure for illiquid assets and particularly property funds. Are they suitable for daily traded, open-ended funds, or is another solution more appropriate so they can be used? Yeah, they remain an important asset class, a very useful diversifier for a portfolio, but it's important that investors have confidence in the fund structure, because this kind of repeated suspension when investors can't get their money back is not a great advert for the investment industry, and it kind of undermines investor confidence in all that the industry is trying to do. So, what has the FCA been doing in this? Well, there's been a big consultation going on over the last 6 to 9 months, and really the FCA has been looking at, should these types of funds have a notice period, so that you need to tell the asset manager that you'd like to sell the assets, but you won't get your money back for maybe 3 months or longer, maybe 90 to 100 days, so 3 months to 6 months in that. And obviously that would create a very different investment environment, where you would need for your clients, where you've got property exposure, to give 3 months notice to 6 months notice before you get the proceeds of the sale. Now that's, in some respects, a very sensible proposal from the FCA, because we know that selling buildings takes a long time. And it seems slightly crazy when you think about it, that if you sold a holding in a property fund today, that would be priced tomorrow and you'd get your money back in 3 days, regardless as to whether the underlying properties had to be sold. And we know from our own experience of buying and selling houses and so on, that any physical property transaction takes a long period of time. So this notice period has obviously caused quite a lot of interest and controversy, particularly from the asset managers, who are saying, well, if you put this in place, then we would expect lots and lots of people to sell before it comes in place, and we'll be left with no funds. And that will actually perpetuate the problem of illiquidity again. What we've seen over the last few months, as things have eased with the pandemic, and particularly with the outlook for the property market in the UK, is that the funds have reopened and that we've got some normal behaviour going on again. But 2 of the asset managers, Aegon and Aviva, who both were running, let's say, smaller funds in the property space, it was still in the hundreds of millions, but it was smaller than average, have actually chosen to close their funds completely. They're selling down the properties and they will be giving back the proceeds to investors. So that is already telling you that there are some challenges in the property sector. Now, the FCA has listened to this feedback in the consultation. It's taking that on board and it's gone away to think about it some more, gathered all the views of the industry, and we're waiting for the final decision there. So that should come, I would think, by the end of this year. And so we'll be looking closely for that. I would imagine that many of you will have clients that have exposure to commercial property funds and may have had exposure to these funds that have been suspended over the last 12 to 18 months. So you will need to look out for this very carefully as well, and understand what it means for your clients' portfolios, and what rule changes are likely to come from the FCA. So that's number one, illiquid assets and property, a really big topic, not going away anytime soon, and will have big ramifications for large parts of the industry. So let's look at the second big issue, I think, over the last 12 to 18 months. Something called the assessment of value statements that asset managers need to do. So this came into being from the FCA's asset management review paper right back in 2016, and they wanted all asset managers annually to release a statement for each fund that they have, to show how these funds are delivering value for investors. So I think that's actually a very positive step forward that the FCA took, to force asset managers to sit back and look at the funds, not just from a performance perspective, but from many other angles too. Now, this has been in place since the beginning of 2020. So we've now had over a full year of every asset manager putting out an assessment for value statement. And now we're a long way through 2021. A lot of those companies have now put out their second assessment for value statement. And so it's been really interesting seeing how asset managers are judging whether their funds are delivering value for their investors. And we've seen some change out of this. We've seen some asset managers converting investors in a more expensive share class to a cheaper share class. We've seen some funds close or merge on the back of this. But to be honest with you, the vast majority of funds, perhaps surprise, surprise, we've been told are delivering value for investors, even though I think when we would look at them from our investment research perspective, would probably say they're not doing that great a job. And so this has prompted the FCA to kind of do a midterm report on assessment for value. And so they have looked at a whole raft of assessment for value reports from the asset management industry. The report's available online. I would urge you to go and take a read of it if you're recommending and researching investments for your clients. And it perhaps will come as no surprise, it certainly hasn't to me, that they have said there is significant room for improvement in what asset managers are saying in their assessment for value reports. And one of the really interesting things I think is, if we go right back to when the rules were announced, it was said that every asset manager needed to have an independent director to kind of put robust challenge to the asset managers, to be a champion of the underlying investor, to hopefully deliver change and make sure these solutions are working. Well, the FCA has explicitly said in this interim review that the independent directors are not providing robust challenge, and that the evidence they are seeing is actually found that this has got a lot further to go, and these independent directors can do much, much more. So further review is being done in 12 to 18 months. I would see this as a little bit of a warning shot across the bows for asset managers in terms of upping their game as they do their next assessment for value. But again, this is a really important document that if you've got clients that are holding investment funds, you really should be reading the assessment for value report each year from your asset managers. And where you have issues, where you have questions, where you have challenges, you really should be going back to those asset managers and putting those constructively to them to make sure that these funds are delivering in a way that meets the objective and the client need. So let's look at another issue, one here called host authorised fund managers. Now, this is where the asset manager outsources a lot of the administration, all of the administration really, of the underlying funds to a third party. And it's a kind of rapidly growing part of the market as more and more people launch funds. And again, the FCA has reviewed this part of the market to see how it's been working as it's been growing over the last couple of years. Now, once again, we have seen room for improvement in many areas, particularly on oversight and governance issues. That this clearly is a very important part of running a fund, is the oversight and the governance to make sure it's invested in line with how we said to invest. We told investors it would be, that we're sticking within all of the rules and the parameters laid down in the rules from the FCA, and a whole host of other areas. Now this is, although they were looking at the host authorised fund management market, so these third-party companies, actually this is a reminder to all asset managers of where things need to be improved, can be improved, tidied up, and again, upping their game for asset managers for the aspect of administration on the funds that they are offering to investors. So kind of a neat follow-on to the assessment for value. If we take these two together, it's really telling all asset managers, we think you could do better in the fund solutions that you're putting into the market, both in the ones that you launch and then the ones that are managed on an ongoing basis there. So the FCA has said that they'll do further work in this area, and they may well, if they see fit, make rule changes in how this part of the market operates. So again, an interesting area to keep an eye on to see what the FCA is saying, because many funds out there are outsourced to a third-party administrator. Now, it feels like a really long time since I've said anything about Brexit. A few other things in the news to take Brexit away from the headlines, but of course during 2021, since the agreement was announced, if I remember rightly, on Christmas Eve by the government, that they announced a deal with the EU, then this has major impacts on financial services, on investments and on funds. But really importantly, no agreement was had with the EU on financial services. So all of the rules that were applied to the UK, there has been no follow-on agreement to have any kind of different structure at all. Now, up until this point, the FCA has said that all of the rules that, if we think about the UCITS rules and the MiFID rules and all those types of things, have said that they will just come into UK statute and they will continue to apply as they are. But now things start to get perhaps a little bit more complicated, maybe a little bit interesting, maybe even a little bit simpler. We're not quite sure yet, of course, but it's because there is no agreement with the EU, it's actually giving the government and the FCA the chance to look at those rules that we've taken onto statute and say, are they good? Are they actually doing the UK industry, the whole financial services industry, a lot of good, or can some be improved to help perhaps increase creativity, to reduce cost, and deliver better outcomes for investors? Now, one big area of this that is being looked at is MiFID II. So this is a vast bit of legislation that tells tells the asset management industry a lot of things about how they operate their business, about transparency, about dealing, about commissions, and many, many other things. Now, this is one area where there is some speculation that MiFID II could be scrapped here. Now, this won't happen anytime soon, but it is something I think people need to be aware of and need to keep an eye on and have an understanding as what that might mean for any of their investments. But we would fully expect, if there is an announcement made about MiFID II and scrapping of any rules, that there would be a very long transition period to enable industry to react to that, to embed new rules in their businesses and change processes there. So I don't think we're going to see anything happen soon, but it just shows that, although Brexit might feel like it's a little bit in the rearview mirror for financial services, it's still very much on the agenda, and that things can and probably will change over the next few years. So that is a quick run through some of the key regulatory issues that we've seen over the last 12 months. There are many, many others. We could spend a whole presentation talking about those, but I thought it would be useful also to give you an update as to where we are in the world right now. We're a long way through 2021. And there are many interesting things happening. I'm going to focus on just a couple of those. I thought I'd start with a chart telling you where global markets are today, year to date. So I ran this on up to the 13th of August, so a little bit out of date from when you're looking at this, but it shows that it's been another fantastic time for equity markets. Here, the S&P 500, should say all of these returns are in sterling. The S&P 500 up 18% at the time of this chart, year to date. Another very strong year for equities. MSCI World, Europe, even the UK being up there, but obviously not quite as much as the US. But broadly, equity markets around the world they are doing very well this year. Now, what isn't doing quite so well is fixed interest markets. And that, we can see on here that this is being a much more challenging time for fixed interest markets after a very long positive period. And this is all to do with thinking about what's going to happen next in the economy in the future rather than what is happening today or what has happened in the past. So let's look at bond markets here. Let's try and dissect what is going on this. And the challenge in bond markets is all about investors trying to understand central bank policy, about what will the Fed do next, what will the Bank of England do, the ECB, the Bank of Japan, etc., etc. Because up until now, it felt like it was reasonably clear. We had, if we go back to the start of the pandemic, bond markets, bond interest rate expectations kind of slashed. There'll be no interest rate rises for a very long period of time, and so that was supportive for bonds. But things changed with the announcement of the vaccine, of course. That gave investors hope that things could return to normal much faster than was originally predicted. And of course, returning to normal means economic growth, it means inflation, and it therefore means higher interest rates. So we saw, and we have seen, bond markets start to price in the expectation that interest rates would rise sooner than they thought. And that's really what's been driving this volatility in the bond market and the challenges. We've seen the Federal Reserve say they are happy to let inflation run higher than they had in the past. So we've moved from an absolute target of a number to a long-run average target of a number, with the Fed saying if it runs above that average, that they're not likely to increase interest rates anytime soon. But if inflation stays stubbornly high, it may well be that they have no choice but to raise interest rates to try and cool some of that inflation and take some of the heat out of the economy. So interest rate increases are expected, but the question on everyone's lips is when. And if you can answer that question, then you'll have a fantastic way of navigating the challenges in the bond market. But the trouble is that most people think they can't, and you're getting relatively mixed signals from different speeches of economists, central bankers, and so on. And so digesting that, I think, becomes a little bit of a challenge. And that's why you're seeing volatility, not just in the bond market, but also in the equity market too, because obviously the two go hand in hand. Higher interest rates means borrowing is more expensive, which means it's harder for companies to borrow to grow. And therefore that could take some of the heat and excitement out of the equity market, which, as we know, has been hitting record highs in many countries over the last few months. So an interesting time, lots of uncertainty in the bond market, bond yields have been volatile, but of course what that means is for a lot of cautious investors who have got maybe money invested in lower risk portfolios. Now, those lower risk portfolios have got more money invested in bonds. By nature of, in the long run, bonds are lower risk. This creates a little bit of a headwind and a challenge. And so it's been harder for lower risk portfolios to deliver positive returns, particularly this year when you've got, you may have 60, 70% invested in fixed interest in bonds, and those assets have actually lost money in 2021. So far, that becomes much more of a challenge. So for your lower risk clients, really important to understand what's going on in the bond market, what that means for their portfolio, and kind of managing expectations about the returns. And that maybe having a year where things are a little bit more challenging after perhaps the good previous years where bonds have done very well isn't actually outside of expectations, really. So let's look at another area. This is China. Now, China is really unsettling equity markets right now. There's been a significant crackdown on business. We're seeing huge intervention from the Chinese government. They are looking to make the regulatory environment much more robust, really trying to bring it in line with developed markets, trying to gain global investors' confidence that the Chinese economy, the Chinese market, has got a strong regulatory framework around it. Now, that's all part of being a more resilient economy and less reliant on the US. You'll know that up until this point, really over history, China's been a kind of an export manufacturing economy. They've made things relatively cheaply. They've sold them around the world to the UK and the US and so on, and that's fueled their economic growth. But things are changing, and therefore, and China is becoming a much more of a domestically focused consumption economy, much like the UK, much like the US, and it's that transition that's kind of having a few teething troubles. It wants to be less reliant on exporting and manufacturing, but it needs a regulatory framework that supports that. So the likes of your Alibaba and your Tencent and these other massive companies that make up a significant part of the emerging markets benchmark, the Asia benchmark, they've all had their troubles as the regulatory crackdown happens. Now, the bottom picture on the right-hand side there is a recent example, as the Chinese equivalent of Uber called Didi. Now, that has had its knuckles severely wrapped. It listed in the US. It's a Chinese company, and China, the Chinese government's been really focused on data, data protection of people using it, and subsequently with DD really coming under scrutiny, its shares have more than halved since it floated not very long ago. So we're seeing massive short-term volatility in China. It makes up such a large part of Asia and the emerging market benchmarks that there is it's causing some pain to anyone that's got exposure to that part of the market. So in our portfolios, the AJ Bell portfolios, in our higher risk portfolios, we have meaningful exposure to Asia and China and emerging markets, because over the long run, we see them as hugely attractive for growth. But again, short-term pain that the markets need to look through. So that's another major issue that's affecting equity markets right now. So how can we help you with all of that? Just kind of in the last 5 or 6 minutes, just want to introduce you to something called the AJ Bell Fundamentals service. And this is really a service to help you with your investment research. You're out there researching funds, you're meeting fund managers maybe, you're doing your due diligence, and this service, Fundamentals, helps you kind of leverage the work that we're already doing in meeting fund managers and doing our own due diligence, and you can access our opinions on over 75 funds that we think have got a very, very good chance of meeting their investment objective. They're funds and ETFs, active and passive, and they're monitored by myself and my team. We keep on top of the events that are happening, and we change those funds as and when we see fit to make sure that they're really funds that we think have got that very best chance of meeting their objective. So let's just look a little bit more detail about how it works. Now we look to identify these investment solutions that we think can achieve their stated objectives, and that's really, really important as a starting point, because a definition of a fund's success is to deliver its stated investment objective. It might not be to beat a benchmark or so on, maybe it is to beat a benchmark, but it's not always about simply outperforming a benchmark. So we collate this into a usable list of funds and ETFs covering both active and passive to put through our due diligence process. And then this is all put together on our fundamentals page of our website to help you filter and look at what we think is interesting, who we think are those good fund managers that have got the best chance of doing that. And then we produce reports and data on those funds to help you with your due diligence process. So we can look at a couple of those things here, a couple of examples around that. An easy filtering tool. So if you're looking at, we've got on the example here, if you're looking for strategic bond funds and you want an active fund, then it brings up the shortlist of those active strategic bond funds that we like, with some key information there. And then if you click on and expand that selection, then you can see more information too. So information and comment on every fund. You can see the example here. We've got the Artemis US Select Fund. Why do we like it? Some performance data, what its objective is, and then a little report on the fund, giving you our thoughts on the fund, updated when we've met fund managers there. So we will write a comment, an update quarterly, all of those managers we've met over a quarter, we will update and tell you what's going on in the fund, what's changing in the fund, and giving you our view on that. So a couple of different screen grabs of what information is there to support you in your research process. So how can that help you in your day job? Well, this is about supporting your due diligence and your research process to enhance your governance process. So we would hope that it's there to slot in alongside your existing process, not to replace your process, because you will have your own due diligence process for selecting funds and investment solutions, but it's there as a support aid from AJ Bell. It gives you access to the work that we're doing in the AJ Bell investments team and that research. And if you haven't got the time or the inclination or the access to fund managers, then it gives you the ability to tap into our meetings with those fund managers and thinking and hearing what those fund managers are doing and the changes to the team or the philosophy and process or the key stocks that have been driving or hurting that performance. Really, I see it as providing an additional set of eyes and ears to the market. And if we take that right back to the beginning of the presentation and thinking about those regulatory changes, enables you to think about how does the AJ Bell investment team digest those regulatory updates. How's it changing our thinking on the types of funds that we think are able to deliver on their objectives? So that is a kind of canter through the key regulatory changes over the last 12 months. A little bit of a race into what's going on in markets. I could do a presentation on each part of this presentation, really. There's so much there. Lots and lots, hopefully, to think about and digest. If you've got any questions that come out of any aspect of this, then please do talk to your normal AJ Bell contact. They would be delighted to hear from you. Or if you want to contact myself and the investment team, then again, go through your AJ Bell contact and they will fire any questions or queries that you have on any part of our service. They will send that over to me and we would be delighted to have a conversation with you to help you with your processes and your business and your client solutions. So thanks very much for listening, and we look forward to speaking to you again soon.
Thank you, Ryan. If you have any questions for Ryan, please use the chat function provided and the team will get back to you. Up next, we're joined by Fidelity's National Development Manager, James Bird. James joined Fidelity International back in 2015 and is now responsible for managing national relationships with major distributors.
So a very good afternoon. Thank you for joining us. My name's James Bird from Fidelity International and welcome to our presentation on the Roaring 2020s. Now, what if I told you that there had been a global pandemic that had lasted for over 18 months, affecting people's lives in unimaginable ways? What if I told you that in spite of that, stock markets had hit record highs? And what if I told you there was the promise of a decade of prosperity and a new way of people living their lives? And now, would I be talking about the 2020s or the 1920s? Now, when you think about the 1920s as a time period, it probably brings up images of parties, of people having fun, of the Great Gatsby. And I've actually got a quote to share with you to bring this to life. And this is from Fitzgerald's The Great Gatsby itself, from the book. And he says, "The parties were bigger, the pace was faster, the shows were broader, the buildings were higher, the morals were looser, and the liquor was cheaper." And although that does sound like a lot of fun for this presentation, we are going to take a little bit more of a serious tilt and think about some of those trends as we compare both the 1920s and the 2020s. So in terms of taking you through that journey, I'll move through the important information straight into the learning objectives, which I think offer a roadmap for the next half an hour or so. So we're going to start by providing an insight and really trying to draw some parallels between the current market environment and the market environment of the 1920s. I'm then going to sort of leave the here and now behind, and we're going to take a very forward-looking view and try and understand the implications and think about how powerful trends are set to emerge and re-envisage the investment landscape. And then, as always, I'll bring it all together at the end and think about how should portfolios be looking considering all of the above. So quite a lot to get through in the next half an hour or so. So let's get straight into it and start with a point of reflection. And in this section, I really want to think about some of the current macro themes that are important for you and for your clients, and think about what do these mean in terms of framing them versus the 1920s. So I'm going to start with a very eerie photo. I think this is a superb photo. This is from an American football game in 1919, and you can see everybody wearing masks. Not much social distancing going on. Quite an interesting photo in itself. And this was taken at the height of the Spanish flu, which lasted between 1918 and 1920, which sadly saw nearly 100 million people passing away globally. Now, what's particularly interesting is when we look at trends back from the Spanish flu, consumers saved more money during that time period than they saved in any 2-year period till after the Second World War. So forced to stay at home, this led to a big wall of cash back at the start of the 1920s. Now, if I make a comparison forward to the 2020s, again, this is a fantastic photo. This was taken at the reopening, the very first reopening day back in April in Soho. And you can see the emotions on people's faces. There's a lot of different stuff going on in this particular photo. And it really talks to the fact that after the pandemic that we've had, consumers have saved up more money than ever before. So here in the UK, consumers have saved £180 billion worth of cash on the sidelines. And again, when we think about the argument moving forward, there's an argument to suggest that this money is ready to be deployed to fire up the UK economy. And I think the real question here is, what will this mean in terms of inflation here in the UK? Now, I'm perhaps a little bit more cautious about this narrative around runaway inflation, and I know this is a big topic of interest in the market at the moment. The reason being that typically when we look at post-pandemic spending, and this is not just the 1920s, but over the last 300 to 400 years, history tells us that on average, consumers after an initial bout of spending are actually quite cautious in the 2 to 3 years afterwards. Now, if you think about your own lifestyle, I'm sure like many of you, you've been out for a haircut after lockdown, but there's only so many haircuts you can have, and I'm even saying that with my 3 weekly haircuts, but there's only so many haircuts that you can have at once. And if I was going to make an argument for inflation this summer in the UK, I'd say it's perhaps like a typical British summer. And we might get some sunshine, we might get some heat, but I think the economy, like the weather, perhaps in no great danger of overheating. So I did mention overheating, and it's probably a quite nice segue through to thinking about equity markets in the 1920s. Now, of course, this was one of the most famous periods for equity markets, and you can see there on the screen I've put together a number of different newspaper clippings that really highlight what was going on. Now, interestingly, back in 1920, the Dow Jones fell by over 30% before making up those gains the following year in 1921 and going on to make five-fold gains before, of course, the famous Great Depression and the Wall Street crash in 1929. Now, what's particularly interesting is this was driven by a new kind of investing, whereas you could do this thing called buying on margin. So speaking to your stockbroker, as long as you put down 10% deposit, your broker would put down the other 90%, and that of course led to huge speculation in markets. Now, if I was going to draw comparisons forward to today, of course one of the best returning assets, if you can call it that, has been a joke cryptocurrency called Dogecoin, with a dog on the front of it that I don't think has any use, despite being spoken about by Elon Musk. So we are starting to see a little bit of frothiness in markets. Now, if I was going to make a direct comparison to today, again, if you look at the slide behind me, you can see that this is equity markets going back to the crash that we saw last year. That will feel very familiar. But moving forward, and since then, equity markets have been pretty much unstoppable. Interestingly, there was a note earlier this week from Bloomberg that suggested it's now been over 200 days without a 5% correction in the markets, and that's a record going back for over 15 years. Now, if we think a bit more broadly about where might markets go next, is the argument, I suppose, is will we see those kind of gains coming for the next decade that we saw in the 1920s? Again, sorry to be maybe a little bit more cautious than some commentators in the market, but I think there are three key areas that we need to be more cautious about moving forward. So the first is thinking about the unknowns around the Delta variant and around future variants of COVID. I should say, I absolutely hope that we do not have any more future variants or lockdown. I'm very optimistic about the future. But when you think with your investment hat on, we only have to look in places like China at the moment that are struggling with outbreaks to see that that can derail both the economy and subsequently the performance of equities. So that's the first thing. The second thing that I'm considering is the fact that equities, by any historical standard, are considered to be fairly rich in valuation, and I think that is an area for concern. And thirdly, and perhaps the most important thing that I'm keeping an eye on, is the amount of central bank support that we've seen for equity markets over the last 18 months. Now, to put this into context for you, over the last 18 months, central banks, and this is all world central banks together, have added $1.2 billion worth of liquidity every single hour into global financial markets. Now, when you just think about how much money that is supporting the wider financial markets and the wider economic system, when we start to hear this narrative and hear central bankers talk about tapering and taking away the punch bowl from the party, we do think it could be tougher moving forward. Again, we're looking quite closely to see what signals there might be from the Jackson Hole central banker meeting over the summer. But again, my base case is we're going to start to see some tapering of that support for the economy and for financial markets towards the end of the calendar year. So I'd probably err on the side of caution when we think about market valuations. Now, when we think about maybe one more sort of theme to summarise the current environment, I'm calling this the Great Fiscal Pivot. And I'm going to sort of bring up behind me 4 different themes that I think are 4 key themes to be focused on for the rest of the year. And now I mentioned it briefly, there's a really sort of a heated debate around inflation. Is it transitory? Will it disappear as the year goes on, as some of those bottlenecks dissipate? Or is it here to stay? And again, one thing I've sort of got my eye on or I'm thinking about is the fact that some businesses have been very open about the fact that they've spent more money or they've raised prices and they don't plan on bringing those prices back down. An example of this is Chipotle. They do burritos and we'll call it sort of casual fast food. They announced last month that they were putting prices up by 4% over in the USA and they're not going to be bringing those prices back down. So there is going to be some parts of inflation that stay in the system. Linked to this, again, looking on the right-hand side is central bank credibility. There's a worry about how do central banks tame inflation and how do they go about actually unwinding this enormous amount of quantitative easing. I've put credibility because there's an argument that says central bankers run out of bullets, although I heard a good quote from one of our multi-asset fund managers who said that whenever a central banker runs out of bullets, he turns to a slightly different cupboard and opens up a whole new arsenal of weapons. So I'm sure they've got a few tricks in the locker to help manage the economy through this. In the bottom right-hand corner, you can see a sort of hat tip to the Green New Deal. There was, of course, the G7 conference in Cornwall over the summer, and there was lots of talk amongst world leaders around creating sustainable jobs and a responsible future. But I'm, again, a bit more sceptical about this. How do we actually pay for this Green New Deal moving forward in a world that's already incredibly highly indebted? Interestingly, last year we added nearly $24 trillion worth of debt to the global pile. That figure is now nearing $300 trillion. Now, the final point of interest in the bottom left-hand corner is around US versus China. Some commentators are calling this the new Cold War. And of course, when Donald Trump was in office, there was a real, I think, understanding or a real focus on trade with China. But on a longer term view, we know these are 2 key countries that are fighting for global supremacy. And I'm very interested to see how that dynamic plays out as the year goes on. One sort of theme that all of these 4 themes come together as is I'm expecting for the next 12 to 18 months increased market volatility. And I think we're going to have to think about how do we manage this as we move forward. So that was probably enough on kind of COVID and the current environment. And hopefully that's drawn out some of the key themes I think that we need to be thinking about in the market. But moving forward, are we going to be heading into a new economic order? And we're going to go with these ladies and we're going to go dancing into the 2020s and take a very forward-looking view and try to analyse and think about some new themes moving forward. So again, I'm going to look at 3 different areas. We're going to think about sectors differently and look at how sectors are evolving. We're going to think about regions differently. And we're also going to think about asset classes differently. And that's about bringing it together in terms of actually what it means for portfolios. So let's get straight into thinking about sectors differently. And I'm going to look at 3 areas. I'm going to look at healthcare and how that's really evolved over the last 18 months. We're going to look at connectivity and link that into technology. And I'm going to argue that these 3 sectors are going to be ones that are crucial for investors to keep an eye on over the coming decade. So let's get straight into it. And you might be offering a collective sigh when you see a slide that says the history of healthcare, but just bear with me as I load this up. Now, what I'm showing you here is some key events over the last 200 to 300 years that have developed and show how healthcare has really developed. Now, if you cast your eyes to the top left-hand corner of the screen, 1796, and that was when Edward Jenner developed the first vaccination for smallpox. But interestingly, if you look towards the part of the slide in 1980, it actually took nearly 200 years to actually eradicate smallpox from the globe. Now, when you look on the right-hand side and you think about the progress and the pace that we've seen with vaccinations over the last 18 months, the amount of available vaccines, the amount of new technology that's being used, I'm going to argue that COVID-19 is leading to an inflection point and a real sea change in innovation when it comes to healthcare. And I think actually moving forward, this could be an interesting opportunity for investors. So in terms of sort of mapping this out for you, on the left-hand side, we've got what we call the initial sequencing of the human genome. Back in 2001, this took nearly 15 years to sequence and cost nearly $3 billion to do it. Fast forward to today and it cost under $1,000 to do the same process. Now, in terms of medical innovation at the moment, this is the current wave of innovation. So things like sequencing cancer biopsies, and at the bottom you can see the development of the mRNA vaccines. That's the current wave of innovation. But it's this next bit on the right-hand side that I'm very interested in. This is the future wave of innovation, where we'll be able to, using the human genome, sequence different cancers from the blood and give people personalised treatment for cancer. Many of us have been affected by cancer or know people that have been affected by cancer. And again, instead of using something like chemotherapy, which is a kind of a one-stop shop, this will give a really focused and personalised attitude to medicine and treating such a horrible disease. Again, looking down the list, you can see things like gene therapy, which will help to reverse or even eradicate autoimmune diseases that people are born with. And when we actually think about what this means, you might be thinking, is this all a bit Lord Voldemort and the Philosopher's Stone? We're trying to get everybody to live forever. I don't think the reality is that sinister. And with our investment sort of hats on and thinking about what does this mean for us moving forward, I do believe that innovators in this space are going to be well placed to take revenue and take market share from some of the incumbents. And as I said earlier, COVID-19 has really been the inflection point and tipping point for the pace of change in healthcare. Now, something that I think sort of leads into this, of course, that helps to drive healthcare is technology. Now, this is an interesting chart, and what I've done is I've shown you the amount of years that it took different types of technology and communication to reach 50 million users. So take a look at the bottom of the screen. You can see a flight, 68 years to reach 50 million users. Again, thinking back to the 1920s, the first commercial airline was actually launched in 1926. And these commercial flights were actually run or flown by ex-World War I pilots who wanted a bit of thrill-seeking. Now, you might call me a bit boring or a bit nervous, but I wouldn't fancy getting in a 1926 aeroplane with an ex-World War I pilot, but there we go. And it did kick off, of course, a new era of commercial flying. You can see, of course, the car, again, popularised in the 1920s through Henry Ford's assembly line, which turned making a car from a process that took a day and a half into taking just 90 minutes. Now, amazingly, his first car was called the Ford Model S. It cost $300 back in the 1920s. And it's amazing to see another innovator, Elon Musk, who's now, of course, just released the Tesla Model S, which I think, and I'm not a massive car expert, but I think it can do 0 to 60 in under 2 seconds. So electric cars are certainly going to be the frontier moving forward. Now, as you kind of cast your eyes up the list, at the top there you can see Zoom, and I've deliberately left it blank, and maybe it gives you a moment to think about, how long do you think it took Zoom to reach 50 million users? It's been 18 months worth of, can you see my screen? And 18 months worth of, I think you're on mute, and amazingly people are still doing it 18 months onwards. But it did only take 2 months for Zoom to reach 50 million users, and that pace of change and of technology will continue to move faster than ever before. So thinking about, again, what this means with an investment angle on, what I've done here is looking back to December 2019, I've shown you the different subsectors of technology. Because I think as investors, when we think about technology and we think about sort of what that means for us in our portfolios, often we think about big tech, so Facebook, Apple, Amazon. But moving forwards, I think that we've got to start differentiating between the different subsectors of technology. So you can see there on the right-hand side, the likes of software and the stay-at-home tech stocks have done particularly well, whether there's the so-called sort of legacy or hard technology, such as hardware or kind of communication stuff, that's actually lagged behind the broader index. So in terms of our technology exposure moving forward, I think we can afford to be a bit more selective when we think about actually investing in this sector. Now, to kind of wrap up sort of this sector and think about a theme that brings it all together, I think connectivity is going to be a further theme, again, that for us as investors we have to consider. Now, on the left-hand side, I've shown you the breakdown of cloud availability, of social media penetration, a number of people with smartphones that are reaching well into the billions. Now, this was a statistic that amazed me. If you have teenage children at home or grandchildren, you might be amazed that there was a survey that came out that said your average teenager spends 3 hours a day on their phone. Now, when I speak to friends that have got kids or speak to clients that have got kids in that age bracket, they say absolutely no chance, is it only 3 hours? The survey's wrong. And again, people are using their phones to connect more than ever before. Now, on the right-hand side, you can see that those big businesses have been the ones that have really benefited so far from connectivity. So the likes of an Apple or an Amazon that can really cross geographical boundaries. Now, moving forward, one thing I would say is I do think that there will be some new some new disruptors that look to disrupt those incumbents. And again, we've got to be sort of very hands-on and take a very active and selective approach to finding those businesses. When I think about what connectivity means to me, I think technology is the enabler for connectivity to happen, but connectivity is really perhaps the most interesting opportunity for our argument for a roaring 2020s. So I think that kind of sort of sets the scene in terms of thinking about some of the new sectors. And I'm going to move on now to think about what does this mean in terms of regions. So I'm going to look at revolutionary China. We're going to have a quick look at entrepreneurial United States and then bring it back closer to home and think about scientific United Kingdom. So in terms of revolutionary China, this of course has been one of the biggest themes over the last 5 to 6 years in terms of the pace of change in technology that's happening in China. And I'm going to sort of address the elephant in the room straight away. There's been a lot of worries over the summer concerning some of the big tech stocks in China and a regulatory clampdown. And the way that we see it is the regulator and the government have always been very involved in terms of the way that businesses are run when it comes to tech over in China. So it wasn't really a surprise. And again, if I'm investing in China on a longer term view, again, I'm thinking about that 5 to 10 year time period as opposed to maybe some of the shorter term noise. Now, there are kind of 3 key themes that you can see on the screen that are really driving this growth in tech. So technological innovation, the digitisation of society, and consumer upgrade. And those 3 together actually come together in the QR code that you can see on the right-hand side. Now, this was a photo that was taken in the city of Shanghai earlier in the year. And it's really amazing. So there was a business that were launching a new video game called Princess Diaries. And as a kind of marketing ploy, they hired 500 drones to light up the night sky in Shanghai. And the way it worked is as consumers or people were kind of having their dinner and walking through the city, they saw this huge QR code up in the sky and they get their phone, they take a picture of it or they scan the QR code and it gives them a link to download the game straight to their phones. Now you might think, God, that sounds really cool. That sounds like the future of marketing and the way that we sell to people. Or you might think it sounds a little bit dystopian, but it really shows that when it comes to China, they are at the forefront in terms of technological innovation. Now again, with my investment hat on, looking a bit further afield, I'm thinking and looking closely to see if China separates from emerging markets and starts to have its own allocation in terms of an index. Now again, when we do think about investing in China with some of these short-term headwinds, I would be looking at an active fund, taking a longer-term selective approach. I think we need to be meeting these businesses to help try and find perhaps some of the better winners and avoiding some of those losers. So leaving the east behind and flipping towards the west, this is a really interesting chart. And what I've done is I've gone back to the 1980s and showed you the top 10 companies globally by market cap at each kind of decade interlude. So you can see how the narrative kind of changes. So in the 1980s, it was all about the USA. In the 1990s, it was all about the fact that Japan were going to rule the world forever. 2000 was all about the IT stocks. 2010 was all about peak oil. And 2020s are all about big tech. And if I had my kind of crystal ball and we were looking forward over to the year 2030, I'd be thinking, where are we going next in terms of finding the winners of the future? Now, of course, this is the million-dollar question, but what I would say is link back to some of those themes that we were discussing earlier and think, where could we look perhaps to maybe outside of those big tech stocks to find those winners of the future? So I am keeping a close eye on some of the mid and small cap space over in the USA. Another area that I'm also keeping a close eye on, which leads quite nicely into my next slide, is thinking about the UK. Now, my headline is an interesting one. UK science is set to lead. And really over the last 2 to 3 years, we've seen a real focus, not just from the government, but from the array of businesses you can see on the screen that are now turning the UK into a global science powerhouse. We've got the second largest life sciences industry behind the USA and growing incredibly quickly. as I said, there was a commitment from Boris Johnson and the government towards research and development over the coming years. And when I speak to some of the portfolio managers at Fidelity, they think that over the next 20 years, UK science could be one of the biggest driver of investment returns and of the wider economy moving forward. Now, I was a bit dismayed actually, because my background prior to joining Fidelity was a secondary school history teacher. I did a history degree, and I heard on the radio earlier this year that for the first time in over 2 decades, more people have signed up to do science degrees than have signed up to do history degrees, which perhaps shows the interest in this field, or perhaps it just tells you that my old students were right all along and sir, history is just a boring subject. But I'm going to disagree and say it's all to do with COVID and the interest in science. One final point I will make when it comes to thinking about the UK as a market, remember that we're still very undervalued compared to both Europe at a 20% discount and still trading at a 40% discount to the USA. So again, for your long-term active stock pickers, I think the UK looks like a fertile hunting ground. So let me sort of bring this all together, because we've covered a lot in terms of the comparisons between the 1920s, we've thought about sectors and we've thought about regions. And for the final 5 minutes, I'm going to say, what does this really mean for portfolios? So again, I'm going to focus on the role of equities and dividends. I'm going to do a very quick reminder on fixed income. And then I've said alternative types of investing, but I'm really going to focus on cryptocurrency, because although many of us may not be investing in it, there are lots of sort of, I guess, ideas in the markets about it, and I want to kind of give my sort of 2 cents on the future of cryptocurrency. So let's start by thinking about the role of equities and dividends. What you're looking at here is your blue line is your annualized 10-year dividend growth versus your red line, which is inflation. And you can see on the right-hand side the difference between the 2 lines and how actually dividend investing, despite a little hiccup last year, should be primed to come back nicely over the next 2 to 3 years. A couple of points I would make if you're looking for your dividend investing ideas, and I wouldn't be chasing businesses with a high yield. Earlier we spoke about the threat of a new variant, and what I would say is if you're thinking about this sort of what businesses should I be looking at, it's those that typically have more cash on the balance sheet and are maybe run a bit more conservatively. Because if we did see one of those new variants come along, it means that they can batten down the hatches and again preserve cash on the balance sheet. Again, if I'm thinking about the wider dividend environment, of course, the UK typically has been a good hunting ground for investors, but I'd be looking perhaps a bit more globally. Again, there are some interesting opportunities when we look a bit further east. So for dividend investing, I'd say look globally, but be cautious. Don't think about chasing a yield. Now, thinking about fixed income, because fixed income has had probably a slightly rougher year than equities on the basis, of course, that worries that inflation's coming back and rates might be going up. And I always bring it back to these kind of 3 quite simple 3 pillars about why do we use fixed income. It's for a source of income for clients. It's for safety, so it's to offer perhaps more protection than equities. But crucially, it's to offer that diversification from equities. So when we do see a big blow up in the market, it should offer that downside protection. And again, if you're looking at your fixed income exposure, you want to be looking at funds that are truly fixed income funds. And again, maybe a strategic bond manager that could be looking to pull the different levers to help manage what could be a trickier year for the asset class. So that brings me quite nicely onto crypto. You'll see some quotes from Elon Musk on the right-hand side, and I'll come back to the chart on the left. So in terms of kind of my thoughts on crypto, I've got 3 or 4 perhaps reasons that I'm cautious, and one thing that's making me just keep an eye on it for the next 5 to 10 years. So the first thing to say is we're a long way from this being regulated here in the UK. I think the FCA have got a lot of work to do in terms of getting their head around how do we market crypto for clients, and is it accessible, and is it right that clients should be using cryptocurrencies. So I think regulation has a way to go. The second thing to say is it's a very volatile asset class. So clearly equities fell by some 30% last March. Just to give Bitcoin as an example, it reached 64,000 this year before halving, and then I think it's back up to about 50,000. So I think you need quite a tough stomach to keep up with the journey when it comes to cryptocurrency. The third thing to say is there's I think a worry around the environmental impact. And I think, of course, there's that statistic where Bitcoin miners use more energy than the whole country of Argentina. So I think we need to see more of that energy come from renewable sources. And finally, I think it's a very complex environment. Like many of you, we spend a lot of time trying to read and get our head around things like the blockchain and Ethereum and the way that it all works. And I don't know about you, I find it really complex. So I think from an understanding perspective, there's still quite a way to go. And the one thing that does sort of mean that I'm not dismissing it, and I am watching very much with interest, is that chart on the left-hand side. It's an excellent chart from Deutsche Bank, who have actually mapped the number of internet users versus the number of blockchain wallets. And they've made a prediction going forward in the next sort of 15 to 20 years. And just to put it into context for you, back at the end of the year 2000, and when we started to see the sort of the dot-com bubble burst, there was a headline in a newspaper that said, "Is this the end of the internet? Nobody's using it anyway." So if we think about we're at the same time or same sort of part in the market with cryptocurrencies, again, there's lots to be cautious about, but it's one to keep an eye on, I think, as we move forward over the coming years. So let me wrap up. Think back to what I said about those comparisons to the 1920s. I think the role of central banks and monetary policy will remain important. But again, it's going to be fiscal policy. Remember that great fiscal pivot that we spoke about will be the big driver, I think, of considerations for the next 12 to 18 months. And when we think about actually what the pandemic's done, it's created a step change in innovation, which is evident across regions and sectors. And if anything, it could accelerate from here. And again, when you think about designing your strategic asset allocation, there are some big changes happening. And I think it's important to be active, to be selective, but also be flexible as we move through over the coming decade. So we've covered the learning outcomes, and we've got to where we said we'd be half an hour ago. And I'm going to finish with a very handsome Leonardo DiCaprio on the screen. And it's really a toast to all of you. It's been an incredibly tough 18 months. But hopefully the worst is behind us as we move into the roaring 2020s. And I'll revisit my quote just to finish. So the parties were bigger, the pace was faster, the shows were broader, the buildings were higher, the morals were looser, and the liquor was cheaper. And hopefully you can all enjoy a few drinks over the summer as we enjoy the end of lockdown. So that's reached the end of the presentation. We've got to 30 minutes, bang on time. Thank you very much for listening, and we hope to speak to you soon.
Thank you, James. It's now time for a quick coffee break. We'll be back in 5 minutes for some technical insights. Welcome back. Next up, we have our Senior Technical Consultant, Charlene Young. In addition to analysing and commenting on technical and regulatory issues, Charlene is also responsible for designing and providing technical training for all AJ Bell staff.
Hi everyone, my name's Charlene Young. I'm Senior Technical Consultant here at AJ Bell, and welcome to my session today called To EET or Not to EET. So you might have guessed from the title itself, a bit catchy, hey, that this session is all about tax and tax incentives to save. So what we're going to look at today are the various tax wrappers that the government's got to encourage people to save for retirement. And we're going to look at the tax incentives that are offered on the way in, what happens to funds on the way out, and maybe look at a few different scenarios where a pension and a mix of another wrapper might be more tax efficient for particular clients. Now, obviously, financial planning objectives are way deeper and way more interesting than just tax itself. So the objective of today really is to kind of refresh our existing knowledge and hopefully kind of challenge some of our existing thinking about what might be right for different clients in different circumstances. Right, so today I want to go through kind of 4 main sections. The first will be all about member pension contributions. So we'll have an in-depth recap of tax relief, the different methods of tax relief, and how they are applied, and what effect making pension contributions can have to other tax circumstances for clients. Secondly, we'll have a quick recap of the lifetime ISA, and then we'll move on to comparing our EET versus our TEE comparison. And we'll come on to what EET and TEE are in a bit more depth later, but just to kind of set the scene for today, it's just an acronym to describe how different payments or contributions are taxed on the way in to certain tax wrappers, and how funds might be treated when it comes to turn on an income in retirement, for example. So where you see E, it just means exempt, and where you see T, it just means taxed. So EET describes how a pension works. So E, exempt on the way in because of tax reliefs. And then when the funds are in the wrapper, it's E, exempt again because it's shelter from income and capital gains tax. However, on the way out, there will be some tax to pay on the income after any lump sum entitlements. And when we see TEE, it's just the kind of flip. So we're talking about money on the way in that's come from taxed income or taxed monies, for example. Still exempt once in the wrapper, however exempt from tax on the way out. So kind of flipping things on its head. And like I said, we'll go through that comparison in a bit more detail today. And then finally, I'm just going to finish with a slide kind of considering where future pensions and retirement policy might be heading. Okay, so we hear lots of rumours each and every year throughout the year, especially around budget time. So just kind of looking at what's coming down the line and how that might impact the planning that you guys are doing with financial planners for your clients. Okay, so the first section, member pension contributions. This has kind of got the most slides, if you like, the most figures, but some of it will just be bread and butter to you guys, but it will hopefully prove a useful recap. So in terms of tax relief on member or personal contributions, if you find it easier to think about it like that, there's 2 main methods, okay? So the first method is looking at how you might get the tax back that you've paid on some income once you make a contribution to the pension, and that's known as relief at source. And the second method is net pay, okay? So that's where you don't actually pay tax on the income before you pay it into a pension at all. So taking it from your earnings before tax, and that's known as net pay, as I mentioned. Obviously, we could also think about salary sacrifice. That's kind of a different concept and could be a completely whole session on its own, okay? So for time, we're not going to cover that today. We might mention it in passing on a couple of slides. But today we're concerned on pensions with our 2 methods, relief at source and net pay. Okay, so starting with our first one, relief at source. If you're anything like me, it's easier to sometimes put some figures and an example around it. So if we consider a client who has earnings of £78,000 a year, and they are making a 6% monthly pension contribution, and that's gross, the 6% member contribution, and so gross that would be £390 a month. So if we break down their basic pay, So monthly basic pay would be £6,500. Here we're talking about relief at source. So firstly, we're going to actually take the tax off of their basic pay and then look at how relief at source works. So first things first, we look at personal allowance. So a quick check of the earnings, 78,000. We're confident that with no other income, this client has their full personal allowance. So that's taken off there. So that's our £1,047.50 figure. And that gives us pay subject to tax of just shy of £5,500 there. So 5,452.50. Then we need to apply basic rate tax. So the tax deducted would be £628.33, and that's on that first band there of £3,141 and spare change. Secondly, because this person earns £78,000 a year, we know they're going to pay a bit of 40% tax, and that will be on the rest of the band, okay? So of that monthly £6,500, they will pay 40% tax on £2,310.83. So you'll see on the left in the grey column there, our deduction of £924. We've also got to think about national insurance, okay? So our employee rates here, on the first 3,392 will be 12%, and the remainder on 2,311 will be at 2%. Okay, so what our client would get paid into their bank account after that tax had been calculated under PAYE would be £4,494.08. For the purposes of this example, we're then going to assume that they pay their member contribution once they've had those funds in their bank account. So to gain a £390 gross pension contribution within the pension wrapper, our client would need to make a payment of £312. What would then happen is the pension provider would directly make a reclaim of the basic rates income tax from HMRC and pay that into the pension wrapper. That would then top it up to £390 within the wrapper itself. So I think we're all kind of comfortable with how that works in terms of basic rates, tax relief at 20%. However, the story doesn't end there, because our client pays tax at 40%. They are entitled to reclaim an additional 20% tax relief on the contribution. Now, common misconception when people are sort of starting out thinking about tax and relief at source is that also goes into the pension. What it does, it actually reduces your tax bill and reduces the overall kind of net cost to you as an individual, but that extra 20% doesn't actually go into the pension, okay? It will be the £390 overall. And that leaves us with a situation where our client has £4,260.08 in their pocket and £390 in their pension. Now, I do need to point out, obviously these figures are for the rest of the UK. Scottish taxpayers do have slightly different bands and different tax rates, okay? The concept is the same, but obviously the figures will differ slightly for your Scottish taxpayer clients. Okay, moving on to a comparison with net pay, and what I've done is kept the relief at source columns on the left there for you guys to be able to compare. So obviously we start off with the same basic pay of £6,500, £78,000 a year. Now what happens here on net pay, as I mentioned in our introduction, is that the pension contribution comes off gross before any tax is paid. So you'll see there it comes off in that second line, £390 deducted from the 6,500. Okay, before any of our personal allowance or anything like that is taken off. Then we'll go through the personal allowance again. So it will look like the pay subject to income tax is actually less if we went down the net pay route than we did the relief at source. But as you'll see through the calculation, we do eventually end up in the same position. Okay, so because the gross pension contribution has already come off, pay subject to income tax is lower. However, the client will pay the same amount of basic rate tax on that first band, if you like. And then as we go through, you'll see that they'll pay slightly less high rate tax, and that's the effect of the tax relief, okay? Because the contributions come off before tax has been paid, there's less 40% tax to pay. National insurance contributions will be the same there because the earnings level are overall the same. Okay, that's where our salary sacrifice would come in, because that potentially would lower actual earnings and national insurance contributions as well. Okay, so what our client will see is paid into their bank account is £4,260.08, just like the effect at the end of our relief at source calculation. And you'll see there with the bit on the right-hand side that's encircled in red, that we start off at the same basic pay starting point. Okay, so under relief at source, the basic rate relief is added into the scheme, but with our net pay, it comes off before any tax is paid, so there's no kind of extra bonus topped up to the pension scheme, if you like. What I should mention is for net pay is that that's operated by occupational schemes only, but it won't be every single occupational scheme, okay? So you will need to check kind of what method is operated for your clients. The reason for that is because schemes can't kind of chop and choose and mix and match which methods of tax relief they offer. It's one or the other. Okay. So when else can a pension contribution kind of help from a tax perspective? What other benefits have we got here? So the three that I want to kind of focus on today is how making a personal contribution or a member contribution to a pension extends the basic rate tax band. We'll talk about that in a second, and how that lessens the impact of any capital gains tax they might have due that year. How it can help clients who may otherwise be losing their personal allowance because they have a high income. And then finally, how it might impact clients who could be subject to the high income child benefit tax charge. A very lengthy acronym there. It's probably easier just to say it at the end of the day. Okay, so we talk about extending the basic rate tax band with a pension contribution. Like I say, if we look at CGT, it's probably easier to illustrate in an example, okay? So if we consider our example of Alan, he has a gross income of £80,000 and he has a chargeable gain after his allowance of £7,700. So just to recap on CGT, everybody gets an annual exempt amount of £12,300. Any gain after that annual exempt amount that's still there is added to income, and then depending on what tax band that sits in, it will suffer a different rate of capital gains tax. So there's different rates for different types of gain. We'll concentrate on non-residential property gains, okay? So any gain that once added to income sits in the basic rate tax band will be taxed at 10%. It would be 18 if it was gains from residential property. However, in our case of Alan, as you can see from that first colour block at the top there, as he's already firmly in higher tax rate payer territory, and that's evidenced by that grey band there, his gain in yellow, once added to his income, would all at the moment suffer the higher rate of capital gains tax, which is 20% or 28% if that gain is from residential property. Okay, so not only have we got to kind of navigate two different tax rates for CGT, you've got to remember that if the gain arises from a residential property, second property, for example, then it would be a additional sort of amount added onto that tax rate. So Alan, in our example, the blue block there, if we're looking at the no contribution colour blocks, represents his personal allowance for the tax year. The orange block represents his the amount of income that he would pay basic rate tax on at 20%. And then finally, the grey block is the higher rate tax, okay? And then we add on the chargeable gain, the 7,700, and that's the yellow bit at the end. So in that situation, as I mentioned, Alan would be paying CGT on a non-residential property gain of 20%. However, if he made a pension contribution of £32,000 net, or that would be £40,000 gross, what that effectively does, in order to get the tax relief, is extend his basic rate band. So where we see the orange block in the second series of colour blocks there at the bottom, that orange block is now £40,000 larger because it's extended by the gross value of that member pension contribution. And when you add in Alan's chargeable gain, that yellow block at the end, it now all sits within his basic rate tax band, okay? So his actual basic rate band, the upper limit, has been extended by £40,000 to that blue dashed line in the bottom right that you can see. And and therefore his whole chargeable gain sits in a basic rate tax band, meaning he now pays CGT at a lower rate of 10%. Okay, so he pays less CGT as a result of the gain, and he's also benefited from £40,000 in his pension scheme. The second way a pension contribution can help with tax planning is obviously the loss of personal allowance. So for individuals who have an income of over £100,000, I'm sure there's plenty of those amongst your clients, or I should say adjusted net income of over £100,000, their personal allowance is reduced by £1 for every £2 they have of adjusted net income over that £100,000 mark. So the effect of that in that bottom left-hand red box is that where their adjusted net income is over £125,140, they have no personal allowance left. So that first band that we enjoy completely free of tax is lost for those individuals. So how can a pension contribution help? Well, adjusted net income, that definition I mentioned, is worked out by taking all of your income before allowances and net of relief. So here we're talking about all income before any personal allowance, but net of reliefs, and that would include any pension contributions made under net pay. And then what you do is adjust that income by deducting the value of gross pension contributions under relief at source, or I should say, the value of any gift aid donations. So those are the charity donations you make that are eligible for tax relief, and the charity can benefit from that on your net donation. So take off the gross values of those, if there are any, and what that can do for clients who might otherwise suffer the loss of their personal allowance is again reduce their adjusted net income, ideally to £100,000 or below. They get the money in their pension scheme, but they also get their personal allowance back. And the kind of overall net effect of that in terms of an effective rate of tax relief can be up to 60%. Okay, so you might see references in any exam text or financial press to kind of avoiding the 60% tax trap. I would bet it's probably talking about the loss of personal allowance for clients who have income or adjusted net income of over £100,000 otherwise. Okay, finally, what I wanted to talk about is the High Income Child Benefit Charge. I won't attempt to do that acronym because I will just stumble over it. Okay, so for those of you guys not familiar with it, this is where one of the parents of children who would otherwise claim child benefit has income over £50,000. What happens in that instance is that there's a tax charge of 1% of the value of the child benefit for every £100 one of the parents earns above the threshold. What that means is effectively kind of above £60,000, all child benefit is effectively removed. Okay, you have that 100% tax charge. What can happen is obviously one parent can have the higher earnings and perhaps the other one who might be looking after the children in the early stages of their life might not even be earning at all or earning less. This charge applies if one parent earns over that £50,000. So what could happen is that you both could earn obviously £49,500 each, and you wouldn't be subject to this tax charge. But if one of you earned £60,000, for instance, you wouldn't get any child benefit at all. So it's kind of very crude in the way that it's applied. I don't think people would necessarily disagree with the principle of higher earners not benefiting from child benefit, but the way it's applied is certainly quite crude. There has actually been a recent court case, any of you guys who are kind of keep up to date with that kind of thing, on how the charge is recouped. So it could usually be done via self-assessment on the person who earns over £50,000. Okay, so that would apply even if the non-earner actually claimed the child benefit. If you don't normally complete self-assessment, HMRC might actually write to you as a child benefit claimant just to remind you that this charge could apply. That and the method of self-assessment is actually kind of, I wouldn't say necessarily under review, but it has been subject to a Court of Appeal, recent Court of Appeal case, where HMRC actually kind of lost in the way that they were determining and trying to pursue this tax charge over a number of years. So the kind of we'll wait and see approach on that to see if it actually means people who've been subject to this in a certain way, so not across the board, might actually be able to reclaim some tax charges. best way to illustrate the effect of the charge, of course, and what happens with the pension contributions on the next slide is to look at an example. So we've got Adam. He earns £56,000. His partner Laura earns £40,000, and Laura claims child benefit for their 2 children. Okay, so the child benefit that would be payable in this tax year is £21.15 per week for the first child, and then £14 per week for the additional and the second child here in this case. Okay, so over the year, the value of that child benefit would be £1,828. However, because of Adam's earnings, because he's breached that £50,000 limit, there will be a child benefit tax charge to kind of claw back some of that child benefit. So in Adam's case, you take the £56,000, take away the £50,000, and that gives us a 60% tax charge. Apply that to the amount of child benefit that they are claiming, and the higher income child benefit tax charge would actually be £1,096 payable by Adam. So how could a pension contribution kind of claw some of that back or get rid of the tax charge completely? If we consider Adam making a £6,000 gross pension contribution, what he would do, or what he could do, is pay £4,800 net into a pension, and then under relief at source, his pension provider would claim £1,200 and top it up to the £6,000 gross. Adam is then also able to reclaim some higher rate tax on that payment, a further £1,200 because that whole contribution sits, sort of eats up his higher rate band, if you like. So really the net overall cost to Adam will end up being £3,600 once his kind of self-assessment period is finished, and he has £6,000 gross in his pension scheme now. This also reduces the value of his adjusted net income, okay? So same principle as our personal allowance, because you take off the gross pension contribution from his income, 56 minus 6 gives us £50,000, which conveniently is obviously the value of our upper limit. So it also saves an amount of tax, so our £1,096 in the higher income child benefit charge tax that would have otherwise applied, which actually gives an effective tax relief rate on this pension contribution of £6,000 gross of just over 58%. Okay, so not only do they effectively get the child benefit back because they're not paying a tax charge on some of it, Adam obviously also has £6,000 in his pension scheme that he had higher rate tax relief on. So yeah, a really kind of good tax efficient way of saving. Okay, bit of a break from pensions just for a little bit. As we are talking about EET versus TEE, I wanted to talk about the lifetime ISA. So I'm going to have a quick recap of the rules. Obviously, we're going to be focusing on a certain bracket of clients who are eligible for this wrapper. So very quick recap. Lifetime ISA is available to UK residents aged 18 to 39. Okay, and in terms of that age 39, to be able to open a lifetime ISA, you must apply, open and fund that lifetime ISA by your 40th birthday. So in terms of, opening one, it actually means open and fund, if you like. And as long as that is done by and completed before you are 40, that will be a valid lifetime ISA. There's a limit of what you can pay in each year of £4,000, and there is a bonus payable on any amount that you pay in up to that £4,000 limit. That bonus is 25%. I guess if you were to look at it, it's the same principle as getting basic rate tax relief on an amount of money in the same way as we looked at for pensions. But here we talk about a bonus. The 25% is applied as a bonus to the net money, if you like, that you pay in. Okay, and it's obviously paid from monies, income savings that you've already paid tax on. So when we talk about our acronyms, this is very much a T at the beginning rather than an E like pensions. Once a lifetime ISA is valid and open, so before the 40th birthday, payments in that qualify for the bonus can continue right up until the day before you turn 50. Okay, so that's what I want to talk about today, is maybe looking at this group of people who they might not be quite there yet in terms of high earnings, but there is a benefit. If you have a lifetime ISA open, you can then continue to pay into it up until 49, provided you open and funded it before age 40. on the way out, because we're talking TEE here, you can have tax-free access, okay? Monies are E once they're in there as well, okay? They're sheltered from income and capital gains tax, and then tax-free access, just like other ISAs, okay? However, unlike other ISAs, where you don't get a bonus, there will be a penalty charge if you make a withdrawal that isn't under the charge-free withdrawal rules. So to cover these very briefly, the two main ones really are a qualifying house purchase for a first-time buyer, slightly out of scope for today, and our own research actually shows that of the people who answered our recent survey on lifetime ISAs, about 60% were saving for their first house, and 30%, just over 30%, said they were using a lifetime ISA to save for retirement. The others hadn't quite made their mind up yet, I believe. So the one I want to concentrate on today is from age 60, anyone can access their lifetime ISA free of any penalties and any tax. Obviously, because lifetime ISA is, what, four and a bit years old, we're quite a way off from people being able to do that just yet. But, you know, retirement planning is for the long term, okay? So those people who have opened a lifetime ISA in the last 4 years, perhaps they were nearly 40, you know, they've got some years to go, but I'm talking today about kind of using lifetime ISAs for retirement planning. As I mentioned, any other withdrawals will be subject to a penalty, and that penalty is 25%. Now, that might just look like it recoups the bonus, but it's actually charged on the value of the withdrawal. So hopefully if the funds that you've invested in the lifetime ISA have grown, that 25% charge on any withdrawals that don't meet the charge-free withdrawal rules recoups the bonus, but also actually a bit of your investment growth as well. So it's designed to act as a disincentive for early access. But, you know, if you're absolutely desperate for funds, obviously that money can be accessed subject to a significant penalty. Okay, so kind of onto a bit of analysis between the two. The reason I put EET versus TEE is it's all very easy to kind of compare the effective rate of tax relief on the way in to the two products, okay? However, that doesn't really take into account the fact that with a lifetime ISA, at age 60, you can access that pot completely free of tax, completely free of any penalty. So what I've attempted to do is actually look at what uplift you get on net costs, okay? To try and provide some comparison for those clients who can take advantage of both a lifetime ISA and a pension, to see where actually it's not sort of one or the other, where a mix actually might be a very good outcome from them, at least from a tax efficiency point of view in retirement. So on this slide, I've got various different examples. Okay, so the first is a lifetime ISA on the left-hand side, and you'll see I've gone through different figures, so the sum at retirement and what it might cost somebody when they're actually funding the wrapper. Obviously, the slightly bigger columns represent the pension pot on the right, and I've split that down into different tax rates, okay? So for that first one, for example, you'll see 20/20, and basically what that means on the left is the tax rate when earning. I don't like to say accumulating, but sometimes I can't think of a better word. And then finally, the one on the right-hand side will be your tax rate in retirement. So the first one there in the pension side of things is 20/20. So someone who's a basic rate taxpayer whilst earning and a basic rate taxpayer in retirement. The second one, 20/40, you don't really see it, okay? So that would be where someone pays basic rate tax when they're earning, and then suddenly in retirement they find themselves being a higher rate taxpayer. That's not so kind of common, and certainly I wouldn't imagine it within sort of planning circles. The third one there is 40/20, okay? So that's somebody who pays high rate tax whilst they're earning, whilst they're accumulating, and then is a basic rate taxpayer in retirement, okay? So quite common, particularly if you've got an advisor and paraplanning team behind you, kind of planning your tax efficient strategy in retirement. And then finally on the right hand side are 40/40, okay? So those people who are paying higher rate tax whilst earning and also in retirement. And what this slide is attempting to do is to show the different uplift that you might gain on certain investments. So looking across that top row, okay, so for our lifetime ISA, to have a sum at retirement of £5,000, this is before kind of any investment growth or anything like that, just to try and keep it as clear as possible. So across our lifetime ISA and pension pot, to get that end £5,000, we've got slightly different net costs depending on your tax rate. Okay, so within the pension, that will cost a basic rate taxpayer £4,000. However, if someone pays higher rate tax whilst they're earning and contributing, once you've taken off the higher rate tax relief, if they're entitled to it, that would actually cost them a bit less at £3,000. Obviously, with lifetime ISAs, there's no kind of different rates of relief. It's just a 25% bonus. So the net cost of making a payment to a lifetime ISA to get £5,000 in retirement is actually the same on the way in as it would be for a basic rate taxpayer making a pension contribution. Just illustrated it there with the value of the bonus on the lifetime ISA and then the value of the different tax reliefs that would be inside the pension on the right-hand side there. So when it comes to retirement, sort of that second half of the table there, in the pension, you'd be able to take 25% of that £5,000 as a tax-free lump sum, so £1,250 across the board. We wouldn't get the same in the lifetime ISA, but we would be able to take the whole £5,000 plus any growth out completely tax-free. In pension land, obviously, the rest after the 25% tax-free would be subject to income tax, and that's where our kind of retirement tax rates come in, if you like. So for the basic rate taxpayers in retirement, that would mean £750 is taken off. For our higher rate taxpayers in retirement, obviously that would be double at £1,500. And then that gives us what I've described as kind of a post-tax outcome. So of that £5,000 that's in the wrapper lifetime ISA, you get the full five. For our basic rates taxpayers, you would receive £4,250, and then just concentrating on that that higher rate versus basic rate and retirement column, that would also be £4,250. Okay, so on this very last row now, I'm just comparing the percentage uplift on that net cost. Okay, so net cost for LISA was £4,000. The percentage uplift in the blue circle there is the bonus rate of 25%. If we move across to the yellow, that shows the percentage uplift on that original net cost, okay, of our £4,000 is 6.25% once you consider the tax on the way out for the pension pot. And then finally, when we're looking at our green figures there, so our higher rates in accumulation, basic rate in retirement taxpayers, the uplift there is, a very generous 41.67%. Again, I must point out these figures are obviously for the rest of the UK, and Scottish taxpayers would have different bands and rates. So kind of on the face of it, comparing those, if you were a higher rate taxpayer in accumulation but basic rate in retirement, obviously the percentage uplift on that net cost, because it's £3,000 for you to get £5,000 in your pension, is looking the most generous. However, lifetime ISA there at 25% as well in the blue column. Okay. That was quite a lot to take in on that slide in the table. So again, I've tried to put it into kind of a case study to try and show how it might work in practice. So if we consider Susie, who's age 37, she's already a homeowner, okay, and she earns £61,000. She is a mother and she's got 2 children. She currently makes matched pension contributions to her workplace pension of 6% employee and then matched with 6% employer. So that employee contribution is 6% gross. She's got £10,000 to invest, and she already has her emergency fund and actually some stocks and shares ISAs as well. So she's looking maybe at whether she should pay this money into a pension or into a lifetime ISA, or a mixture of the two. Okay, so this slide is trying to talk through those uplift calculations that we saw on that original table, okay. So firstly, if we look at if Susie paid it just into the pension, okay, so she had £10,000 to invest, after basic rate tax relief, that would give her £12,500 gross inside the pension. Now, because Susie's income was £61,000, only part of that pension contribution will get higher rate relief, okay, because she only pays higher rate tax on a portion of her earnings. So you can't get higher rate tax relief on the whole of a contribution if you don't pay enough higher rate tax, if that makes sense. So Of that 12,500 gross, £10,000 net contribution, just over £7,000 gross, that would get you 40% high rate relief. The remainder, okay, 5,430 would get basic rate relief only. So if we then considered if she mixed the contribution, okay, between a lifetime ISA and a pension wrapper, she is eligible obviously for a lifetime ISA. So if she paid the full £4,000 into a lifetime ISA, that would end up, after the bonus, with £5,000 in that wrapper. The remainder she would pay into a pension. Again, almost all of that pension now would get high rate relief because it's the same amount that would gain that £7,070. The remaining £430 gross would get basic rate relief only. Again, as I mentioned, that £5,000 into the LISA has already had the bonus equivalent of basic rate tax relief on the way in. If we were looking at things on the way in, you might be inclined just to say, well, what's the point of doing the lifetime ISA? Just pay it all into the pension. However, if we go back and think about the uplift that we're comparing there, if we compare like the weighted uplift on the net costs to Susie, assuming she is a basic rate taxpayer in retirement, if we look at the pension only, it works out at around about 26%, because obviously we've had some higher rate tax relief on the way in, but not all of the pension by any means. It works out around about 26% when you combine those two uplifts from the table. If we look at the pension and the lifetime ISA, the weighted uplift looks a bit more generous. That's because we're looking at the fact that the payment from the lifetime ISA in retirement could be taken completely tax-free. So it's just not trying to get too scientific, but kind of looking at the weighted uplift there for somebody in Susie's situation who is a higher rate taxpayer whilst accumulating, but likely to be a basic rate taxpayer in retirement. Actually, mixing and matching might, if you were looking at tax efficiency in isolation, actually be a good idea. In both cases here, all of any higher income child benefit tax charge will fall away as well, and full child benefit is reinstated because of the pension contributions, okay? So by any means, I'm not saying forget about pensions, because obviously, as we've looked at in our examples, still very, very valuable in terms of the tax incentives, and not just the tax relief, but actually how they can get rid of things like the higher income child benefit tax charge, but maybe consider a mix and match approach. In that top bit, when we're talking about the pension contributions as well, when you're looking at the figures, don't forget Susie already pays a match 6% plus 6% as well. So that's why only part of this proposed pension contribution will get higher rate relief, because you need to take that initial 6% gross into account. Okay, so we use the example of Susie to kind of get our thoughts in motion about who might benefit from a mix and match approach if they're eligible to open a lifetime ISA. So who else might benefit, for example? So thinking here, obviously clients under 40, if they haven't already got one open. And here we're talking about clients who might have annual allowance issues, or may even have tapered annual allowance issues now or in the future. You might think, oh, that's just ridiculous. 18-year-old clients, for example, aren't, going to even be thinking about this kind of thing. Well, you don't know, by the time they're sort of approaching 40, they might actually have very real issues with high earnings, wanting to maximise their annual allowance and carry forward. So it's definitely kind of, the fact that you only have to open and fund it, it could even be with £1 before age 40, it probably is worth doing if you think these clients might have these issues in the future. And again, since the lifetime allowance has been frozen, £1 million or just over £1 million pension fund might seem like a dream to some people, and when you're talking to younger clients or children or grandchildren of existing clients, it might be a pipe dream. But since it's been frozen, it's going to be frozen until at least 2025, 26. Again, once you add in compound growth, if people are making high levels of contributions, or people are perhaps they're enjoying third-party contributions as well, with some decent investment growth, there are more and more people will be coming close to the lifetime allowance, since it has been frozen and we don't know what will happen to it in the future. So as I said there, it could be a nice handy top up to a retirement fund, and because of the tax-free access from age 60. Okay, so it's not just for first-time buyers. Obviously, that was the main policy intention, and here we're kind of looking at how else it might be used. So again, a top up to the retirement fund. A third point there is what you could do is actually take the payment from the LISA, or take the withdrawal, I should say, from the LISA tax-free at age 60 and actually pay that into a pension if you have earnings to support that, okay? So you basically get a double boost. So you take the money out tax-free that's already enjoyed the bonus when it was paid in. Once you get to age 60, provided you've got the earnings obviously to support the member contribution, pay that into a pension again and you get a double boost of tax relief. So if you're not ready to, perhaps to start making withdrawals. For the first retirement LISA investors, okay, so those people who were investing in a lifetime ISA for retirement rather than first-time property purchase, their minimum pension age is due to be 58, and it may even be higher by the time they reach that again. So just thinking about, just because it's age 60 for LISA and currently age 55 for pension, we probably will see those two converge and even equal at some point in the future. Again, if already a homeowner, it's a kind of handy investment plan for mortgage repayment, perhaps at 60. Again, for clients who want to help their grandchildren and children who are over 18 or just about to turn 18, it might be something to consider. Non-working spouses is also a good example. Okay, so the basic amount for pensions, if you've got no earnings to get some tax relief, is a maximum of 3,600. For lifetime ISA, it's obviously 4,000 net, and that gives you 5,000 in the lifetime ISA. Again, clients who are in receipt of a lump sum gift perhaps, or an inheritance, so they might not have earnings to support a huge pension contribution, or it might just not make sense right now. Again, something to think about, and maybe stagger those lifetime ISA payments. And again, there's an opportunity there where you've got an existing ISA, you can transfer in past year subscriptions and then still subscribe a full £20,000 to a stocks and shares non-LISA in the same year. Again, thinking about those people who already have funds and may receive an inheritance. And again, the self-employed, obviously that could be a whole session on itself as well, but before COVID, even then we were really in the midst of a kind of retirement crisis for self-employed people, and how they were actually going to fund their retirement. So again, perhaps the lifetime ISA with a combination of other things for self-employed people might be something to kind of get engagement, and for those people who fall into the bracket, might be a tax efficient way of funding their retirement. So plenty to think about on that side. Obviously they might not fit into the kind of bread and butter clients for your firm, but again, something to bring into the conversation and like we say, challenge our existing thinking. As I mentioned, pension's still the retirement king for most. This is quite a focused session on a group of clients of a particular age. As we've covered today, pension contributions can claw back personal allowance, child benefit that might be lost. In terms of IHT, a big plus for pensions is they're not usually part of the estate. Obviously, ISAs and lifetime ISAs will be. Definitely don't want to see opt-outs from auto-enrolment and loss of employer contributions. Okay, big fear of the regulator with lifetime ISAs on this one. Obviously, clients with advisors and an advice team behind them, that's very unlikely, but again, you need to point it out. And in retirement, you can still draw up to your personal allowance from the taxable element of your pension. FADES benefits could also help manage tax bands. On the flip side, LISAs are obviously more flexible if you urgently require access. However, that penalty really does more than just reclaim the bonus paid. It is a penalty on your investment growth. LISAs also affect means tested benefits, and they're not protected on bankruptcy in the same way as pensions. Okay, very quickly, the last slide here before I let you guys go today is our pension policy squeeze. So just wanted to have a quick nod to policy and kind of what might be coming down the line. So as I mentioned, the normal minimum pension age is rising to 57 in 2028. We've had the draft regulations for that, and it will be tied 10 years below state pension age from then. Okay, so squeeze on pension policy when people can access their funds. Income tax and national insurance bans frozen until 2025-26, along with the lifetime allowance, as we know. Tax relief reform. It was too difficult in 2015-16 when we saw lifetime ISA sort of come into being before it was officially launched. Is it still too difficult now with the COVID bill to pay? We don't know. If the Chancellor feels that it, and the Treasury feel it's too difficult, he's got two pension limit levers to pull really, the annual allowance and the lifetime allowance, which is already frozen. What's going to happen? We've seen rumours of it reducing further. We don't know what will happen then. What could happen, because it's easier to reduce the annual allowance rather than mess with tax relief, The extreme example could be the annual allowance goes down to, say, £20,000 and it's a joint equal limit with ISAs. Now, that is just me using that as an example for today. Again, we don't know really what's going to happen in terms of trying to repay this COVID support bill. Will the fact that we are living with COVID post kind of the lockdowns of the pandemic, and we might see even more, will this impact savings behaviour further? And we want to build on auto-enrolment success, so will we see some targeted measures for the self-employed who clearly are feeling very unloved in terms of COVID support quite across the board, and we were already seeing that we really needed some measures to help them build retirement pots even before coronavirus. Okay, that just leaves me to say thank you very much for bearing with me today. I hope the session's given you something to think about, and as ever, if you do have any questions, please don't hesitate to get in touch. Thank you.
Thanks, Charlene. As always, if anybody has any questions following the session, please do send them through via the chat function or note them on your feedback form at the end of the session. I'm now going to spend the next 15 minutes talking you through what's new on the AJ Bell Investcentre platform. So I'm going to start by looking at the financial year 21 interim results that came out at the end of March this year. The number of retail customers were up at 346,000 with assets under administration of over £65 billion. And if you look year on year, you can see the retail customer numbers steadily increasing each year, as are the assets under administration. And we know that by offering great customer service, by having a good product range, and by understanding and controlling our costs along with our competitive charging structure, we know that by looking after those areas, the customer numbers and the assets under administration naturally lead to increased revenue and increased profit before tax. And for those of you that do your due diligence on platforms, you'll know that financial strength of the platform and provider that you choose is very important. So from a proposition point of view, just to bring you back up to speed with where we are from a product perspective, we've got the two pension products. We've got the retirement investment account and also the full SIP. I'm going to talk a little bit about the difference between those later on. We've got a suite of ISA products, including the lifetime ISA. And we've also got the general investment account that can be used not just for individuals and also for joint accounts, but it can also be used for trusts, limited companies, other registered pension schemes, and also things like offshore bonds as well. A bit of research that the platform did last year, and we've actually used this slide previously, it shows how investment products and strategies are used by advisor firms. And as you'll see now, we now tick the box for all of those different types of strategies. So whether you run your own model portfolios, whether you use multi-asset funds, or whether you use managed portfolios from third parties, we are now able to accommodate those different strategies within the platform. And looking at it from a managed portfolio service point of view, not only can you use the AJ Bell Investments managed portfolios, but we launched the service with the likes of Brewing Dolphin and FE Investments, and we've since enhanced it by adding further partners such as 8AM Global, Waverton, and most recently we introduced Tatton Investment Management and their portfolios to the platform as well. One of the things that we've been keen to try and do is make the platform as easy as possible for you as advisors and advisor firms to use. With coronavirus, electronic signatures became quite important. So where paper forms are required, we do now accept electronic signatures from the likes of DocuSign, Adobe Sign and others. And we've updated our advisor handshake to show that electronic signatures will now be accepted. But we did also try and remove as much paper from processes as we can, and that is an ongoing project for us. So some of the things that we've done to try and make it easy for you to get business onto the platform, you can now submit new business online for SIPs, retirement investment accounts, the ISA products, and also the standard GIAs. Once those clients are on the platform, you've also got the ability to generate bank details for clients who are looking to make bank transfers. And you've also got the ability now to input transfers straight into the website that can be processed through Origo. That removes the need for you to send transfer paperwork to us where the seeding scheme can accept the transfer through Origo. If you want any examples of how this functionality works, you can of course contact me and the team, and we'll be more than happy to run you through all of that online functionality. Plus, you've also always had the ability to trade online. So whether you're running your own model portfolios, whether you're buying third-party managed portfolios, or you just need to buy some funds for a client, you can do all of your trading online via the website. Most of you will have used the V2 website that we've also delivered over the last year or so. And those of you that have will have seen some of these areas already, but just to recap some of the key points on there, we've got the new fresh looking dashboard, which you'll see on the slide here. We've actually improved the advisor charging dashboard, which gives you the ability to instruct one-off advisor charges for clients. You can also see the advisor charges that are in place for the clients that you've got on the platform. We've created the ability to create a shopping basket of trades, which you can then put through for a client once you've filled the basket with the trades that you're looking to place. We've enhanced the regular investment and the disinvestment pages. There's also now a proportionate disinvestment tool that allows you to proportionately disinvest from a portfolio that the client has on the funds and shares service. And from a more higher level point of view, you can actually view the investments that you're using as a firm for your clients, and you can see the underlying clients that hold those investments as well. So I talked earlier about the SIP and the retirement investment account, and I'm just going to look at some of the differences from a pricing point of view and just introduce why we actually brought the retirement investment account into play. So those of you that are familiar with our custody charge will know that it's 0.2% up to the first million, drops to 0.15 for the next $500,000, and then it drops to 0.1 for the $500,000 after that, with no custody charge when the assets go above 2 million, and a small custody charge introduced where assets exceed 10 million for a client. And we do link a client's products together. So if a client has a SIP or an ISA and a GIA, we will link those products together for custody charge purposes. From a dealing charge point of view, those of you that run your own model portfolios or use the third-party managed portfolio service, you'll see here on the slide that we don't actually charge any dealing fees for trades that are placed through the model portfolio service. So that means if you're initially investing a client into a portfolio, or if you're rebalancing that portfolio, you won't pay any dealing charges as part of that process. For those of you that are using the SIP for accessing discretionary fund managers, the standard SIP pricing is on the screen on the slide now, and you'll see there that it's an initial setup fee, transfer in fee, and then quarterly administration fees. You don't pay the custody charge that the funds and shares service has where you're using the SIP wrapper to access an external investment option. And then coming on to the retirement investment account, the reason we introduced the retirement investment account was for clients that had smaller pension values. We wanted to try and provide a product that allowed you to look at things like prod and your client segmentation and make sure that you've got a suitable product for those clients. And it delivers an all-in pricing alternative to the SIP. So for the portfolio up to £500,000, we charge 0.25%. The assets over £500,000 are charged at 0.2, and there are no charges for things like account setup, transfers in. There's no ongoing quarterly admin charges on the retirement investment account, and we also don't charge if the client goes into drawdown. And the LANCAT did some work on pricing and actually came up with this colour chart for us so that you can see where the pricing sits for the retirement investment account. So you'll see for the smaller clients, we've now got an option at 0.25 for accumulation. The SIP becomes an option for those clients to use from £200,000 onwards. And if a client's in drawdown, you can see that, again, we've now got an option priced at 0.25 for the clients with the lower pension values. And the SIP typically becomes an option from around £360,000 or more where clients are in drawdown. From a development point of view, what developments are we doing with the platform? So just to cover some of the areas that we've been looking at and delivered, and also some of the stuff that's coming soon. From an AJ Bell Investments point of view, we added Oxford Risk as a risk profiler mapped against our portfolios. We also, on the back of advisor and client demand, have launched the Responsible Managed Portfolio service, which goes alongside the Responsible Fund that we launched. So if you've got a client, whether you want to access an active portfolio, a passive portfolio, a blend of the two, or you've got a client who wants a more responsible portfolio, we've now got a solution for those clients that's risk mapped to most of the leading risk profiling tools. And AJ Bell Investments, of course, will only charge 0.15%, and we've removed the VAT on the managed portfolio service, so it is just the flat 0.15 for those portfolios. In terms of developments that will be coming soon, we're going to be adding the ability to have multiple funds and shares accounts within the ISA wrapper, so that will allow you to run multiple portfolio strategies within a single ISA. We have got a new performance report coming in the V2 reporting area of the website. We're improving the advisor charging options that will be available, including things like tiered advisor charging. And we're also taking a wider look at the client onboarding process to look at how we can try and make it as easy as possible for you to get your clients onto the platform. And some of you may have picked up on an acquisition that AJ Bell made. So we actually acquired a technology company called AdAlpha. It's been rebranded as Touch. Now they're actually developing a mobile and app-based platform proposition, which will enable you as advisor firms to offer a digital service for clients that are more suited to that form of relationship, and for clients that are maybe looking to take a step away from the traditional IFA service. It will only be available via IFAs. There's no intention for it to offer any robo advice or guidance. And again, if you want any more information about that, you can visit the website or speak to a member of the business development team. We'll be happy to talk you through what that development looks like. And just finally, one thing I would like to say is just a thank you to anybody who voted for us in the Professional Paraplanner Awards for 2021. We were awarded the Best Full SIP Provider, and that's the 5th year running that we've won that. So thank you very much for your support, and thank you to those of you who voted for us. So that concludes our AJ Bell Connect session. Thank you again for joining us. As mentioned earlier, a feedback form will appear on screen immediately after the webinar closes. We'd really appreciate you completing this to tell us what you thought of today's content. CPD certificates, a copy of the slides, and a link of today's recording will also be emailed over to you in the coming days. If you'd like to test your newfound knowledge, you can take part in the short online quiz. If you're quick enough on the buzzer, you can even earn yourself a bottle of Prosecco. And simply make a note of the link and the access code that's going to appear on screen, and then take part in your own time. I hope we see you in person for our AJ Bell Connect sessions in December. In the meantime, if you've got any questions, your regional business development manager and contacts will appear on screen now.